Yes, as Peter said, good morning, ladies and gentlemen. It seems that the world of refining is somewhat of a happier story than the world of geopolitics. We have two distinguished members on the panel today. We have Philippe Sauquet, he's the president of Refining and Petrochemicals of Total, and Marcel van Poecke on my far right, the head of investment firm Atlasinvest, and back in the day, an owner of Petrochemical. Now, before we hear from both, let me just give you a quick look at some key trends in the industry, just to refresh your memory. So far in 2015, we have seen a stellar year for the global refining industry. All regions had positive margins. For the US, of course, they have been lofty for a few years. Now, thanks to the cheap feedstock and the low natural gas prices, both courtesy of the shale revolution. But this year, quite surprisingly to many, Europe has been catching up, and Asia with a delay as well. Now, why are these margins so surprisingly strong? It seems to be that most of it is the result of growing demand. Now, these solid margins are also the result of a major restructuring of the industry itself. The current profits, one could say, come after past pain. Refiners in the Atlantic Basin in particular have closed overcapacity as oil demand has been shifting from Europe, from the west, say, to the east. Refiners in Asia have closed some capacity as well, in Australia and Japan in particular. But in that reason, in Asia, more capacity was added, especially in the Middle East, of course, in China and India. And that helps explain why these margins there have not been as stellar as the other regions. Now, because of these additions in Asia, in non-OECD Asia, we see that the non-OECD as a whole continues to increase its share of the global market, even as the OECD refineries, as you can see, are using the higher margins to increase their runs. And the question is, of course, how long will the party last? How long will these great margins continue? Analysts have said the whole year, basically, these margins are going to slump. That didn't happen, but we might see some softness around the corner with oil demand growth expecting to soften a bit. With that, Philippe, the floor is yours. Your remarks on the industry.
Thank you, John. So as you rightly said, 2015 we'll have clearly seen the return of downstream, in sharp contrast with what we see, what we live in the upstream. And therefore, well, first, I should be grateful to the organizers to have invited me to speak about refining at a time when the margins seem so favorable. Much easier for me as the head of refining chemicals in Total. So yes, there have been, and you've seen on the chart, a sharp rebound of all the refining margin globally. It has been the case in the US. H1 2015 compared to 2014, we increased from 70 to 90. Asia multiplied by 3, even if it was a bit rockier in Asia, from 10 to 30. And the sharpest increase of all was felt in Europe, where we went from roughly 10 to close to or even greater than 50. So why is that? I was on a panel dialoguing with Daniel Yergin last Monday in Berlin. I'm sure that you know Daniel. very well-known character in the industry. And he was reminding us that during all his career, there were only 2% that he had met who had a real influence on oil price. It was on one side Mr. Supply and on the other Mr. Demand. And this applies, of course, to any commodity, and it applies to refining margin. So Mr. Demand grew by, in 2015, by roughly 1.8 million barrels per day. And this is the sharpest increase that we have ever seen since roughly 10 years. And of course, it's easy to understand why it increased with oil price and oil product divided nearly by 2. That's not a surprise that there is the market price sensitivity, and when we saw this price sensitivity taking place, especially for gasoline, which is clearly our product, which is the most price sensitive, and especially in the US, but also in Asia. So we saw the demand for gasoline in a sharp increase. What about supply? Supply, as you are aware, we have no constraint today on oil supply, which of course is creating difficulty for my colleagues and for groups such as Total. But what matters really is refining capacity. And as John reminded us, a lot has been done in the OECD to close uncompetitive capacity, and -5, -6 million barrels per day during the last 10 years. So it has clearly an influence today. And contrary to our anticipation last year, where we were forecasting to see an increase of the capacity in refining worldwide of more than 1 million barrels per day, we had a very limited increase of the capacity this year, only 0.2. So much less, clearly, than the increase of supply. Why such a low figure? Many factors, technical ones. Building a refinery is not an easy game, and there are a lot of projects that have been delayed for technical reasons. A lot of other reasons, including the one that integrated players integrated on the upstream have clearly less cash today, and they are a bit slowing down their capex, clearly slowing down their capex on the upstream, but also in the downstream. And some projects are taking longer. So clearly, sharp increase of supply and sharp increase in the demand, and supply nearly flat. Europe, as you saw, got the most spectacular growth. And once again, no surprise, refining in Europe has been handicapped for years by the imbalance between diesel and gasoline. I know that it is a very hot topic on the agenda, but it has been a topic since many years in Europe, where regulations, tax have clearly favored diesel up to a point where we have such an imbalance between diesel and gasoline in Europe, but we cannot compensate by even if we are investing heavily in our refining assets, and therefore we have been exporting year after year gasoline and importing diesel. So clearly, when gasoline demand is increasing, it is a clear benefit to Europe, because it lowers our handicap. There are other factors, of course, but which are such as, for example, the exchange rate. Euro dollar was lower. We have most of our costs, of course, in euro, and we took advantage of that. But the main factor is the reduction of the unbalance gasoline, diesel in Europe, which explains why it was so favorable in Europe. Second point, trying to answer John's question, is it a golden age or a swan song? Of course, it's difficult to say, and the most honest answer should be nobody knows. But of course, we need, in fact, to have long-term view in order to progress our businesses. And I can give you at least some parameters that will that will affect, of course, the refining margin, and that we need to monitor closely in the future. One is clearly European demand. We have seen over the past year a strong pressure coming clearly from political powers, but also from society in general in Europe to pressure the industry in order to make and save the industries. I would say the industry in general, including the car industry. Pressure to decrease clearly the energy consumption in Europe, and it affects clearly the refiners, because we see a decline in the demand driven by more efficiency, energy efficiency in our customer base. Less use also of heavier products, which is creating additional constraint of the refining in Europe. There is little demand, if no demand at all, remaining beyond 2025 for the heavier product in Europe. So European demand and European regulation, including CO2, and of course we are very vigilant at what will be decided or not decided at the end of the year in Paris during COP21. The regulation will affect clearly the demand, and we must take that into account. There are parameters that we have more control on, and these are the ones that, of course, as industrial, we focus. New refining projects. So, of course, if the industry is continuing to invest in excess capacity, clearly we could end up very soon in a very difficult situation again. So we have to keep in mind that beyond declining European demand, overall the demand for additional products worldwide is growing very slowly, less than 1% per year. And that means that if the industry is adding new capacity, we will need to close old capacity. So we have to be aware of that. New projects have been delayed so far. Will they be speeded up soon? We'll have to see. We know that in Europe there have been more or less 1.5 million barrels per day of closure that have been announced beyond 2015. This could be failed to be enough, but it won't be enough for the next 5 years. We as Total, we are the first European refiner. We are taken our share of the job to be done, especially this year where we have been announcing a major decision as to restructure our European assets. But clearly, we expect others also to be part of the game.
Thank you, Philippe. Marcel, you are looking at the industry from the position as an investor. Philippe is saying we might be very soon in a very difficult situation. Is your time coming now? What are you looking for if you invest in the industry?
Maybe on Petroplus, we sold Petroplus in 2006 and decided to start investing again in European refining in 2013. And we did that with Carlyle, with the Carlyle Fund. And it's a joint venture with Vitol, which in itself is an interesting construct because you're working with a big trader who is also helping on the supply side. And that's proven to be, I think, a very interesting model. So we started building the portfolio. But if you look at the industry right now and you look at the positives and the negatives, just very briefly, I think one of the reasons why the margins are so good is the sudden fall in crude prices. So that has clearly helped us. That has opened, widened the margin. But also the rationalization of European refining. And of course, if you close facilities, that helps. I'm worried that it's relatively short term. So I'll come back to that. And because those are things, one-offs, especially because, and that's more on the negative side, we have seen big investments in the Middle East, like John also said, in the Middle East, in India and in China. And these are really mega refineries. So compared to the average European refinery, they're 3 times as large. So it's a totally different picture. On the negative side also, we see the emission controls in Europe, which has to be done, that's clear, but it means that you have to invest a lot of capital. The whole economic situation in Europe has not been helping, but we see signs of picking up, so that could be a more structural help in the industry if Europe slowly comes out of the recession. We see a trend also in hybrid, in electric cars. You see some of the cities like London and Paris, and we think more will follow, who ban diesel cars. And then, of course, you have the whole Volkswagen decision. So if you look at that overall picture, I mean, it is difficult, and I think you have to be very careful to invest. So if you invest, and that's completely different from the Petroplus times, if you invest, your investments have to be in flexible sites, large enough, in the right location. You can't compromise, because I think we will see further restructuring of this refining sector in Europe.
Yeah, as you said, Volkswagen issue is hanging over the industry in a way. Ironically, for Europe, it might not be too bad, Philippe. There is an overhang of gasoline and a shortage of diesel. We are importing diesel into Europe.
Actually, it's very early to guess what will be the consequences of this crisis that affects, of course, Volkswagen in the front row. But we can anticipate that there will be consequences that will negatively affect diesel demand. To what extent, you have to be aware that there is a car fleet existing that will not be changed from one day to the other. So all these changes will affect the demand very slowly. But yes, it could affect, and we have already seen before the Volkswagen crisis already some shift in the perception of diesel from the politician, but also from the car consumers. And what we anticipate is a slow shift compared to the past trends. But first, this will be slow. Second, we can anticipate that globally, diesel will remain, at least for trucks, the major fuel. And there will be some rebalancing of gasoline consumption compared to diesel, it should be favorable to European refining, which has, as Marcel reminded us, a lot of handicaps compared to other areas in the world, be it the US, be it Middle East. But at least this rebalancing could help a bit the refining sector in Europe.
Yeah. Let us open up to the floor. We have a question here in the front. Where are the microphones? I should have given you a minute warning. The microphones are on their way.
Herman Franzen, EIG. I wonder if we can focus away from Europe to North America, which has had a great advantage in recent years, an enormous increase in light oil, that the differential between WTI and Brent kept rising. Now, if we believe what Mark Papa said on yesterday, we could see a correction on US light oil, a significant decline if he turns out to be right, and he is the king of the light oil. So that would mean that that differential will go down. Would that mean that the great advantage that American refiners had vis-à-vis other refiners now is beginning to be reduced?
Philippe?
Well, clearly, we have already seen, I would say, somehow a reduction already of the competitive gap between US and Europe this year, as I was mentioning on gasoline. You could also mention that in Europe, the cost, the utility cost decreased much more than in the US, because US, the price of US gas remained more or less flat, around below $3 per million BTU. when in Europe, the gas price decreased a lot in conjunction with the oil price. So clearly, we have a reduction of the competitive gap. We can anticipate if, for instance, the ban on oil export in the US was to be lifted. Yes, there will be additional correction, and the differential between WTI and Brent should reduce. This clearly should help Europe competitive position vis-à-vis US. But we have to be clear: the US remain very favored by low energy price, and we don't anticipate possibility to have a gas price in Europe at the level as they are, and they are likely to remain in the US. So there are many advantages that will remain on the US side. So some rebalancing, but I wouldn't say that the US refining is really threatened by Europe. I would say that European refining is less threatened than it was by the competitiveness of the US refining.
Marcel, you want to add a comment?
You're absolutely right, and I think the structural thing is, of course, the US, even when they will produce less crude oil, they are still a crude oil producer, and we are importing everything here. So that advantage is there, and of course, energy prices are cheaper, gas is much cheaper. So the industry there is really advantaged, and I think that's a structural thing, because in Europe, we don't want to have fracking, etc. So I think that's a structural thing.
We have a question over here.
Casey Sattler at Energy Intelligence. I just wanted to ask about that we've seen in a couple instances of refineries in Europe being converted to biorefineries, and I was just wondering, what economic advantages that offer for some otherwise disadvantaged plants, and is this something we'll see more of moving forward?
Philippe, you just went through the exercise.
Yeah. We had, in fact, to deal with the future of our refining asset in Europe this year. As you might be aware, we had a 5-year moratorium agreed in 2010, which was preventing us from moving ahead with certain decision. But this moratorium ended up in spring of this year. And so we had to address situation of structurally loss-making site. And one of this site is the site that we have near Marseille in the south of France, La Mède. And we just run the exercise of converting the site from crude distillation to a biorefinery. And clearly, we see some merit to that. Well, first, we have on one side declining demand for classical refined products in Europe, when we see still a very strong growth in biofuels, fueled by the regulation. And of course, regulation, we are always very careful, because politicians might change their mind. But nevertheless, we see still the biofuels increasing. There are some already decisions that have been announced at the European level of having 10% of renewables for the fuel cars, transportation more in general around 2020. And we are far from being at 10% today. And we have even some other countries like France, which ambition to go further, and there is a law in France which states a number of 15% of renewables in the gasoline and in the diesel pool. And therefore, to make the bet that it will make sense to have more biodiesel production seems to be very reasonable. And when we run the economics, we see economics in doing that. Not great economics, but I can tell you much better economic compared to continue with crude distillation on a site where we were loss-making by $100 million per year during the last 5 years. So it will be a sharp increase of our results with this transformation.
And some of it smells better than diesel as well. Yeah. You wanted to?
No, just not on biorefineries, but in general on the conversion of these sites. That's an interesting topic in itself. So what you see is, as the industry restructured, a number of these sites, which are in the right location, are big enough, get a second life. And that can be a biorefinery, it can be an LNG import plant. That's what happened in Wales. Can become a storage facility. So there is life after these refineries close. different, but different destinations.
We have a question over there.
Lily Chin from Diamond Key International. Yeah, we are looking at refining. So I think when oil price is pretty high and we see a lot of international companies and are closing off that refineries in the US, Europe, and Australia in the developed markets. And the emerging markets where the refining are increasing, but they are heavily subsidized by the government. And when the oil price is about $19 to $100, we're talking about every barrel we refined will lose average $5 US. Now, the question is, with the lower crude price right now, and with the current change landscape of refining capacity, which moved from West developed countries to the emerging markets, what is the current margin, if it's a positive, for the current refining industry? And
in general?
In general.
Would you like to take it? You are more global.
With the overall profitability of refining in general today? Well, today the case is really compelling for very good profitability in the refining worldwide. And the only question, of course, is once again to guess whether it will last or not. And if the oil price is back again to a higher level, we anticipate some tough times. It's true for Europe. It might be still the case in Asia, because you mentioned that a lot of refineries were subsidized in Asia, and of course this can lead to overinvestment, and we have seen that in the past. And so Asia remains a place of attention for the profitability of its asset there.
Marcel.
Maybe I think and I think Total is a very good example. I mean, to have a sustainable refining business throughout the cycle, I think it became much more competitive, it became globally much more competitive. So you have to be in the right location with a very flexible refinery, and also have the scale to be able to compete. And I think what we have been seeing the last years is that companies like Total in Antwerp, Exxon is a case in point, who also did big investments in Antwerp, build the scale in the right location in Europe to be able to be competitive. And I think if you're not in that place, like I said earlier, it's difficult. It will be difficult to compete globally.
You have really to be very selective in your investment decision and to focus on the best asset, because it will be structurally a very competitive industry, and the less competitive asset will be loss-making when the cycle will be down again, but for sure.
We are nearly out of time. We will take the last question over there.
My name is Philippe. I'm with Bloomberg Intelligence. My question is about LNG as a transport fuel. We've seen a couple of LNG filling stations being built by Shell. Is this just a marginal phenomenon, or could this become big? Could this be bigger even than biofuels? And what does it mean for refiners in terms of, will you have to invest to include LNG in your portfolio as well? Thank you.
Easy answer for refiners. We'll not make LNG in a refinery. That's not the idea. But as you might be aware, some integrated players such as Total or others, we have also LNG, and we'll be more than happy to supply LNG to customers if there is a real demand on that. For us, LNG will take its part in transportation, that for sure, and we see that happening right now. Having said that, we see clearly a compelling case in the US, because once again the price of gas is so low there that there is a case for gas being used in transportation. Can be compressed gas, can be LNG. Both have their own merits, because LNG you need to liquefy gas, and this has a cost. But we see clearly a case in the US. In continents where you are importing gas, okay, and it's true for Europe, it's true for Asia, importing gas means transporting gas. It's a costly operation, and therefore yes, there will be a share, but we don't anticipate it to be a major share in transportation in those continents.
Thank you very much. The time is up. The refining industry has tremendous margins. Clouds are on the horizon, and we can still invest in it. It's contradictions, but it worked. Thank you very much.